Okay, cool. So the best way to pass this test, like I said, is to take all the practice exams and go back and study the parts that you got wrong. If you study the questions that they give you, then it'll give you a better chance of passing the final exam through the state. You only need 70% to pass the final exam through the state. That's it, 70%. All right. About 53% of people pass on their first try. Okay, 53 to 57, I think, pass on their first try. So how can you become one of the 57%? Just do what I'm saying for studying. Okay. Most of the exam, like a huge portion of the exam, I think like 30 or 40%, is the rules and regulations, the last couple chapters. Okay. So you want to study those. Also, if you check in GroupMe in the pinned messages, you're going to see a lot of resources there. There's a study guide that's like 84 pages that has like everything you could possibly need to know for it. There's your courses. There's the practice exams, all that stuff. So you really want to just study for the test, like study the test. All right. And use my YouTube channel. All right. youtube.com/@lifeinsuranceexamprep. That'll help you. I have a bunch of videos on there that'll really help. So, but focus on the laws and rules and regulations too. In the pinned messages in GroupMe, there's some videos in there that go over the laws, rules, and regulations. I'm not really going to cover those right here because they just literally bore me to death. And I don't want to go through it, and you guys would get bored to death too. It's kind of a weird topic to lecture on. You really got to like read those, you memorize the laws, stuff like that. And I'm not trying to die today, so I'm not going to go through those because I think it's very boring for me. So you can see I'm getting really red here, my vitamins, but I'm going to cover, let's just see, raise a hand or put it in the chat. If you want me to cover things like policy riders, you want me to cover types of life insurance, I'll list off some topics here, and then we can cover everything. Okay, Portia said everything. All right. So let's do this then. Let's cover life insurance, different types of life insurance at first. Okay. Oh, annuities. Yeah, annuities confuse people. So let's cover annuities here. Okay, we'll cover the basics of an annuity. And keep in mind, guys, I haven't taken my exam for years. All right, so I might not be, there may be some things that I don't know as well as you guys. Okay, that's just me. It just is what it is. Dividend. Okay, cool. So keep the things coming in the chat there. Dividend options. That's really good. So an annuity. Okay, I'm going to draw an annuity. Okay, so say this is Mr. Jones. Okay, Mr. Jones. He's really happy. Why is Mr. Jones happy? He's got big eyes. He looks evil. Wow, he looks evil. He's happy. He's like me. He's losing his hair. He's happy because he's retiring. Okay, he's 65. He's retiring. All right, and he's got a milli saved up in his 401k. Okay, so he was about to buy a brand new fishing boat, but his wife said, no, honey, you got to put this into an annuity income stream. So he said, okay, maybe that's what I'll do. Instead of buying a fishing boat with my $1 million in my 401k, I can buy an annuity. So what he did, he took this $1 million in his 401k when he retired, and he put it into an immediate annuity. Okay, single premium immediate annuity, SPIA, single premium immediate annuity. So then what happens with this is this starts kicking out income payments to him. Okay, that's an S. Yes, please don't mind my drawing. So he retires. He has his $1 million in his 401k. His wife doesn't trust him to not just go buy a boat and all this other stuff. So they say, okay, we're going to take this and instead of having a big chunk of cash, we need income. Okay, we need money that we know we're going to live off of every month. So can everybody see this? What I'm going through here? If you're on your cell phone, it's probably going to be a little harder to see, but hope you can see. Most people should be able to see this. So I'll explain the concept though. He gets $1 million, and he retires with $1 million in his 401k. He takes it, puts it into an annuity, which is a product that a life insurance company sells to create an income stream. So he's like, hey, yo, here, take this money. I don't trust myself. I want you to pay me a certain amount of money every month till I die. Okay. Now, if he outlives a certain time, then there's different things that they can set in the annuity too. So if it's just like a regular basic annuity, then if he dies in a year, the insurance company made a ton of money, right? But if he lives another, 25, 30 years, then he made out like a bandit, and the insurance company ends up paying him more money than he put in. So what really happens, guys, is the insurance company takes his money, invests it, earns interest on it, and hopefully just pays him money on the interest that they earn, plus a little extra. Does that make sense? Why an insurance company would want to do that? If anybody have any questions about the basics of how an annuity works, that kind of makes sense. It's like if you imagine if you got kids, right, and your kid won $100,000 scratch ticket, you'd be like, no way, you're giving me that money, I'll give you like, $1,000 every 2 months or something, so they don't just go buy something dumb, right? That's kind of how an annuity works in that sense. So that's a single premium immediate annuity. It's called an immediate annuity because he puts this money in here and he starts receiving income payments within a year. Okay. And he's sad because he can't get his boat. No more boat for Johnny. But he can go on fishing trips. Okay. So immediate annuity. Okay. Now, if it was a deferred annuity, then this stage right here would be more than 1 year. So say he retired, right? And he wanted to have his income payment start, say he retired at 65, and he's like, you know what? I got a bunch of money saved up and other stuff. I don't need to have my income payment start until I'm 7. Say he's going to push, so you don't have to start collecting Social Security until 72. I think that's the latest you can push it off. It may have changed, but I'm pretty sure that's, at one point that was it. People can start collecting at 65, I think, and then you can wait until 72. At least that's what it was when I took my exam. So imagine he says, you know what? I'm just going to wait until I'm 72 to start collecting. So I'm going to give you guys all this money when I retire, and I'm going to wait until 72 to start collecting income payments. So that would be a deferred annuity because he's waiting more than 1 year. So what happens is he gives that insurance company the money, and that 1 million may turn into like, 1.2 million, say, for example. And then he's after, 7 years, this is just an example, right? He has it in there for 7 years, and then he starts getting income payments off that 1.2 million. Does that make sense, guys? Kind of how a deferred annuity would work? Okay. He's like, hey, take this money, hold it, make some money with my money because I don't know what I'm doing, and then just start giving me income payments down the road. This can also be used. Imagine someone has grandkids, right? And grandpa, grandma were very wealthy, and so we got grandma and grandpa, okay? They passed away. Rest in peace. Okay, that's across there. Rest in peace, grandma and grandpa. But they're going to bless their grandkids with all this money, okay? But instead of giving it to them at one time, they take this money and they put it into a deferred annuity so that when their grandkid turns 18, he can start getting income payments. That's another way that a deferred annuity could work. Does that make sense? Yeah. They're like, we don't want to give him any, he can make it till he's 18. And then once he's 18, then he starts getting the income payments. Okay, another way a deferred annuity may work is if, say, someone younger wants to start one. They're like, hey, I'm just going to put money into this until I, retire, and then I'll get the money then, right? Okay. So it's liquidation of an estate. Life insurance creates an estate, right? An estate is just you got money to leave behind. So if you ever want to leave a legacy, leave an estate for your family, life insurance is the easiest way to do it. Walt Disney actually started Disney with a whole life policy, cash value from his whole life policy. I don't know if you knew that. So if life insurance wasn't a thing, neither would Disney. Actually, he would have figured it out how to do it because he was a pretty smart guy, but he didn't give up. But yeah, it helped. So now there's immediate and deferred. Everybody clear? Raise your hand if you're not clear on immediate annuity or deferred annuity. Okay, you can't. Which one? Are you confused about deferred? What it means? Deferred means they start receiving money more than 1 year after starting the annuity. And immediate means they start receiving money less than 1 year after starting the annuity. Does that make sense? Okay. Anyone else still confused on the immediate versus deferred annuity? Okay. So then there's fixed annuity and variable annuity. Okay. Fixed annuity is when the insurance company says, hey, we're going to take your money and invest it in our company's general investments. Okay, usually pretty conservative, right? They're life insurance companies, so they're like the richest companies in the world, and they invest conservatively. They've invested conservatively for hundreds of years, and that's why they have so much money. So they're like long term. They say, hey, you know what? You may sacrifice some gains if you went in the market, but there's not really going to be any risk. The insurance company assumes the risk. Okay, so the insurance company assumes the risk in if you invest in a fixed annuity, meaning it's like a guarantee. They have guarantees, right? So deferred annuity is when the money in the annuity is invested in the stock market. Okay, so in a deferred annuity, a variable, in a fixed annuity, you're putting money in and it pays out based on like how much that's built. In a variable annuity, it pays out based on how the stock market's fluctuating. Okay, so if someone retires, what would make more sense, fixed annuity or variable? Put it in the chat. What do you guys think? Think if someone retires and they want their money to be secure, think they want to do a deferred annuity? I mean, no, not deferred, fixed annuity. Yeah, exactly, fixed. So if someone retires, they want it fixed. They don't want to take that risk. Okay, it's called suitability. So also there are different provisions of annuities. Like there's period certain is one of them. So it's like life with period certain, right? So say you had says I want income payments for my life, and I'm going to get a guaranteed payments for 20 years or something. Meaning if I die within that 20 years, if payments were still like, so say like if I get a life with guaranteed, a life with period certain, okay, and that period certain is for 20 years, it means that I want to receive income payments for the rest of my life. If I die within the first 20 years, which is that period certain, my beneficiary will start receiving the payments. Does that make sense? The period certain guarantees that if they die within a certain period of time, then someone else starts getting the money. So say John and Betty retire, and John and Betty retire at 65. John says, well, I have my annuity. I want to get payments until I'm at least 85. And if I die before 85, my wife needs to keep getting that money. Okay, we're going to assume that if we live to 85, then we probably got enough, someone will take care of us, right? So he says, I'm going to get a life with period certain, and it's going to be a 20-year period certain. That way, if he dies, Betty keeps getting the income payments for the remainder of that 20 years. Does that make sense? Anybody confused on what that means? You can raise your hand virtually or come off camera and just give me a little wave. Okay, so that's the basics of an annuity. It's just it's It's a way to liquidate an amount of money. Okay. I personally think they're a ripoff. But it all depends, right? I guess it all depends. There are some situations that make sense, but I don't know. They're good at selling them though. They're getting better though, because interest rates weren't high for a while, right? So it was like, you know, at one point people were losing money to inflation if they had an annuity. Now it's different. Well, not really, because inflation's been crazy, but whatever. So next we're going to talk about dividend options. Okay. Dividend options. Okay. So dividends. We love dividends. We actually don't have dividends in our policy. So guys, which companies typically pay dividends? Anybody know this from your course? Mutual or stock companies? Correct. Yep. No, mutual companies typically pay dividends. Okay. So a mutual company. So stock companies pay dividends to shareholders, Augustine. Okay. So you can own stock like blue chip stocks, right? And they pay dividends, meaning the company owns a profit and it pays a dividend to the person who, one of the people, the stockholders. But in the life insurance, mutual life insurance companies are not owned by stockholders. They're owned by the policyholders. Okay. So those are the big companies like New York Life, Guardian, Mass Mutual, the Northwestern Mutual, like the big money companies. They're mutual companies. So they're owned by the policyholders. So when the company declares a profit, the profit goes to the policyholder, not the stockholder. Does that make sense? Because there's no stockholders in a mutual company. It's policy owners. Cool. So first one that we're going to talk about are paid PUA. PUA. Paid up additions. Okay. It's one dividend option. All right. So what this is, it's additional whole life insurance that's paid for when it's purchased. So your dividends go to buy whole life insurance that does not require a premium anymore. You guys remember learning about the single premium whole life policies? Maybe you haven't. So I'll give you an example. So some whole life insurance policies you can pay every month for the rest of your life or until you reach 100. Okay. There's some whole life policies where you can buy a single premium whole life, meaning you give them a bunch of cash, one single payment, and then they say, okay, you're going to have a guaranteed this much life insurance for the rest of your life. You don't have to make any more payments on it. Does that make sense? So imagine like if you went to Geico for car insurance, you're like, hey, here's like $65,000. I never have to make another payment on car insurance in my entire life. Right? Or maybe it wouldn't even be that much. I don't know. Say you pay, that's probably way too much. But you guys get what I'm saying, right? If you could just go to Geico and say, hey, I'm insured for the rest of my life. Here's just a big chunk. Because if you pay your car insurance like 6 months in advance, you save a ton of money. You save like 20% or 25% or something like that. Right? So I always pay like 6 months at a time. Boom. That way I save a lot. So when people do that, they actually get more insurance for their dollar. So they got to pay more up front, but over the long term, they pay less. Now, the reason why companies do that is because you're able to give them more money and then they go earn interest on your money. Right? So they make more money when you give them that money up front because they're like, cool, now we're making interest on this money. That's why companies take so long to refund you too. You ever know that? You know that? Why it takes 10 to 14 days to get a refund, but they pull your money right away? Because they're making interest on that money for an extra 10 to 14 days. Pretty crazy. So paid up additions, that's what it is. You're doing buying a small single premium whole life policy, okay? So say someone has $100,000 in whole life and they get dividends that year, meaning the company declares a profit and they say, hey, some of this money is going to go back to our policyholders. Then one option is to say, yeah, I want paid up additions, meaning instead of having $100,000 in life insurance, I'm going to have like $100,000 in, $100,150 in insurance or something like that. They're still only paying the premium on the 100,000, right? But they actually have 100,150 because they use the profit that the company made to buy insurance, more insurance. Anybody, if someone's still confused about that, raise your hand. I can explain it, try to explain it a different way. I think Cameron's iPhone would put dividend options. So that thumbs up or just, yes, if you understand it in the chat. And if you don't, then say no. Okay, I'll assume you do. So paid up additions, additional insurance. Another one is they can reduce the dollar amount of your premium, okay? So say if your annual premium is $500, so you pay $500 a year on your policy, and the company earns $150 in dividend, $150 in dividends, they'd only have to pay $350 for their annual premium, okay? So another one is reduce premiums. We're getting pretty good at the spelling thing. Okay, reduce premiums, okay? I'm doing it with my mouse too. My handwriting is not like that messy. I actually pride myself on my good handwriting. So second thing they can do is reduce their premium. Does that make sense, guys? Raise your hand. I think that's kind of a pretty straightforward one. Right? You get that? Company declares a profit. Say, hey, the dividend's $150 for your policy this year. You're like, cool. My premium is my annual premium is $500. So put that $150 towards my premium. Now I only owe $350. So you only have to come out of pocket $350. Kind of like credit card points if you go to buy flights or something. All right. Okay. Another one is it paid in cash money. So it just gets paid out in cash to you. So you can have them mail you a check for your dividend. So in this case, they'll send you $150 for your dividends. Does that make sense? Yeah. Okay. Another one is to reduce. If you have an outstanding loan on the cash value of your insurance, you can use the dividends to pay off the loan. So when there's cash value in a whole life, you can take a loan against the cash value. Okay. So if you have a loan and you earn dividends, you can use the dividends to pay back the loan. Any questions about that? Okay, you'll learn about cash value and all that stuff when you get into insurance policies. Another one you can do is accumulate at interest. So, hold on, we'll do loans. And we'll put ACC. Accumulate at interest. So with this, your dividends will earn interest at a rate that's specified. You can withdraw the dividends at any time without affecting your policy's cash value or the death benefit, but accumulated dividends may not be redeposited once they've been withdrawn. Okay, so you can say, hey, keep my dividends and just pay interest, or let's keep earning interest on them. That makes sense? Okay. And then another one that you can do is premium offset or reducing the payments. Premium offset, PO, premium offset. It's not police officer or post office, it's premium offset. So with a premium offset, what this does is you can have your, so there's some life insurance policies where I want to have a life, well, some of them you can have it so that your dividends, if it's accumulating enough dividends every year, because the dividends will grow and grow and grow. If it's accumulating enough dividends every year, then there may become a point in your life when you don't have to make payments on your policy anymore. All right. So you can structure a policy so that, hey, when I turn 65, my dividends just keep covering my premiums. The money you're earning ends up being equal to or more than the amount the policy actually costs. Does that make sense? Now, the biggest one usually is this, the paid up additions, okay? And I'm going to show you why. Don't know if this would be on your exam. May or may not. They always change those things, but I'll show you this. This is you're gonna see the power of dividends here. Okay, and accumulating interest, compounding interest. So say you have $100,000 policy, okay, and then there's a dividend declared. So you have $100,000, 150 as a death benefit, right? The next year. Now, the dividend is being earned on this $100,150 policy instead of a $100,000 policy. So say next year, instead of $150 in dividends, you get $100,000, or you get $160 in dividends. So it'll be $100,310. Because the first year when the dividend was just based on $100,000 of insurance, you made $150 added into your policy, or your policy face amount increased by $150 when you use paid up additions. Now the company is saying, hey, well, now you don't just have $100,000 of insurance, you have $100,150. So the new dividend is going to be based on the policy of $100,150, not $100,000. So you're going to earn a little more. Okay. And then the next year, you're earning a dividend on a policy that has $100,310. So say you're getting 100,000, in that year, it's like it just keeps increasing, right? So that over time, it compounds, because it's going to go up more and more and more and more by bigger amounts every year. So your face amount's going to increase by increasing amounts every year. So one year it increases by this much, the next year it increases by this much, and then this much gets added to it. It's like compounding interest. So then after 20 years, and your cash value is accumulating based on a policy that's that big too. So as the face amount of the whole life grows from the paid up additions, the cash value is growing a lot faster as well. So there comes a point when these policies, they just gain like huge cash value over time. All right. And they're a lot of people use them as ways to store money as an investment, especially if someone's in like a high tax bracket, because then it helps with taxes and stuff, because you can take money out of it and not pay tax on it as a life insurance policy. So say someone's earning like a guaranteed 6% rate of return or something on their life insurance. If they're in a 40% tax bracket, that's like a crazy good investment for them, and they don't have to pay tax on it. So paid up additions, the power of paid up additions is that your policy just compounds and gets bigger. It's a snowball effect, right? Starts little and it trickles and gets bigger and bigger and bigger. The dividends just start piling on top of each other. So those are the dividend options. Now, a dividend is just unused premium, okay? So a dividend is just unused premium. That's why it's not taxed, because you're not making money on it. The company calls it unused premiums. So mutual companies that pay dividends, they charge more money for their policies. So what they do is they'd say, okay, your policy is $500 a year, right? Like this same example we're using. So they say they're $500 a year. And then they say, hey, you know what? At the end of the year, they say less people died than we thought would die. And we made more money on our investments than we thought we'd make. So we had less expenses and we had a higher return. So we actually overcharged you for your premiums, because their premiums, insurance is risk. spread out against a bunch of people, right? So they said, we're going to charge you $500 because based on the risk of you dying and all this stuff and what we think is going to cost and what we're going to make and everything else, it's going to cost you $500 a year. And then at the end of the year, they say, hey, yeah, it only costs us like $350. So we're going to give you $150 of that back. Do you want it in cash? Do you want it to use to buy more insurance? Do you want us to use it to accumulated interest like we had? Do you have a loan? Do you want us to use it towards a loan that you have out on your cash value? So that's really what dividends are. It's a profit, but the way, if you put money into something, you earned a profit, you'd have to pay tax on it, right? Well, the Bitcoin guys figured that out the hard way. So like stocks, you put money into a stock, you earn money back, you have to pay tax on anything. You buy something, you flip it for a profit, you're supposed to pay tax on that. The way they do it in this is the insurance company says, oh, no, well, that's just unused premium. They didn't make a profit on it. We're just giving them some of their money back. You guys see there, like the loophole that they're able to use? Yeah, it's kind of crazy. It's kind of wild. I don't know how they get away with it, but they do. Actually, I do know, because it costs the state more money, costs the federal government more money to not to tax life insurance than not to, right? Because imagine if some guy's a breadwinner for his family and he makes $100,000 a year and he has a $2 million life insurance policy. Well, if he dies and his wife has to pay 40% tax on that, so she only gets like 1.2 million out of the 2 million, then, because right, that's what happens. So the tax would be like half of it, which is wild. So then now that wife's like, okay, cool. Well, now we got to move. We got to, so it would actually cost the government more money having for government assistance by taking that tax money than for them to not tax it. That's kind of the argument that the lobbyists use, because trust me, they want to tax it. But yeah, so that's why it's a tax-free death benefit. So they got some stuff there, but you can't just like put a ton of cash into it. They passed a law against that in the 80s, I think. They called it it's called a modified endowment contract. You'll learn about that. If it violates the rules of how much you can do, there's like a limit to how much someone can put into a policy to make money on it in the dividends and stuff. If it violates a certain rule, then it's a modified endowment contract. Cool. All right. So you're doing this. Mark, you're funny. You're like, I do know how to spell annuities. I like that. Yeah, it's funny. Okay, anybody have any questions about that? All right, well, what I'm going to go over is what you have to look forward to when you get started working here. Okay, we have brand new agents doing very, very well, making anywhere. I mean, we have many new agents making over $1,000 a week consistently, and it just grows over time. All right, when you start doing this, you're going to want to put more effort into this probably than you've ever put into any job ever before. Okay, I recommend putting like 50+ hour a week commitment for the first 60 to 90 days. Okay, that way you just kind of grind it out, because this is what happens, guys, when you take it on an endeavor like this and you're trying to be independent, create an income for yourself. Like most people in life in general put an average level of effort into things and into their goals and into their success. Now, why do a lot of successful people, why does it look like they enjoy it? Why do you think that they feel like it almost looks like they don't even feel like it's work? Because they're putting in the amount of effort needed to see their goals happen, right? So if you're only putting an average action and effort into something, rarely are you going to see you accomplish your goal with it. But when you go above and beyond and put that extra effort in, and you start seeing your goals happen and you're accomplishing your goals and you're making it happen for yourself, then it doesn't really feel as draining. Like it's more draining to work 40 hours a week and not make much money than work 60 and like crush it per se, right? Say that was the option, right? If someone was like, hey, you can work 40 hours a week and make $800, 700 after taxes, or work 60 and make 1,800, what would be more draining? Probably working the 40, making 800, right? So successful people put in that extra effort enough to see their goals happen. So it doesn't even become draining, because you're like, yeah, this is great. I'm seeing the result. So we have new agents do that so quickly and consistently. And we can help you take this whatever direction you want. So there are some people who are like, hey, I don't want to put in a big effort like that for a long time, forever. I'll just do, just first couple months. Hey, that's cool. Once you get to that point, after those couple months, you'll be able to produce by yourself, not need help from anybody. No one in the country has a system that we have. We provide you all the leads that you need, all the clientele, all the pipeline, everything. We have full training. All you got to do when you start is literally read your script. That's it, and get someone on the phone to help you close your sale. So we have full hands-on training all the way through. When I started, I had to know all my products, all my presentations, all my applications. I had to buy leads. It cost. Most insurance agent guys, when they start, the company wants you to spend $1,000 a week on leads starting out. Like most companies, that's what they want to do. We don't do that here. We provide you with all the tools you need. You're not a client of ours. You're an agent. You work with us. We help you succeed. But hands-on right from the beginning. All right, so we help you like not have to worry about knowing everything before you start. All right, so once you get your license, we get you appointed with the carriers. We get you contracted with us. We get you set up with your leads. We show you how to work our system. And then, hey, if you want to take this and grow a business out of it with us, awesome. I'll invest my own money into you. I invest an average, if anybody wants to take that route after a year, about $8,000 to $10,000 a month into helping someone grow their own thing with this. Okay, obviously you have to display leadership skills and be good at it, but that's a big commitment. That's like 60-hour-a-week commitment. There are other people who are like, hey, no, I'm not trying to do that. I have people here who, once they get the system down, they're working 30, 34, 35 hours a week, doing real well for them, making $1,000 to $1,500 a week consistently. They have other people working more, making more, right? So it's really whatever direction you want to take it. And your income grows every year, because just like insurance policies earn dividends, you earn renewals. So you get paid for 10 years on everything you sell. So you get paid the first year, and then you get paid subsequent years after that. You get paid for the next 9 years as well. This is actually our home office in Vero Beach, Florida, Senior Life Services. So that's if any of you live near Vero, that's the address, 2300 3rd Court. I'm not there. Obviously, that's not my background. It's just a background, But yeah, so I started in this business a little over 3 years ago at SLS, about 3.5 years ago. Completely changed my life. I went from making about 50,000 a year, 50, 60,000 a year to more than that every month now, right? That's a huge change for me, my family, everything else, and helping other people on the path to doing there. My goal, my job, I don't want to set goals for you. My job is just to help you accomplish whatever it is that you want for yourself, because everybody's at a different stage in life. I got no kids, I'm not married, not in a committed serious relationship. So it's like, I got all the time in the world. Okay, cool. Any questions about that stuff? We're getting started. All right, cool. All right, well, this is a career, guys. It's not a job. Job, J-O-B, stands for just over broke, right? Working week to week. Your money's already spent before you get it. Here, I want to help you create a surplus. So I appreciate you guys for being here. Hope that we're able to see you guys all get started. How early can you start? Oh, you can start at 8 a.m. You can call from 8 a.m. to 9 p.m. local time, making calls. All right, we'd sell all over the country. So essentially from 8 a.m. to midnight. So essentially if you get licenses, non-resident licenses in California. If you want to get a license in another state, all you got to do is pay their little fee. That's it. You don't have to do another test or anything. It's all reciprocal. Once you get in one state, then the other's good. Some states, if you're not a U.S. citizen or you became a citizen, like if you're not a natural born U.S. citizen, then they require like extra stuff to, for immigration stuff to make sure no one's like stealing anyone's identity or anything. But other than that, it's usually pretty easy. So, all right, cool.